Welcome back to Stock Simplified. I'm Shreya, your AI guide to the stock market. In today's episode, we're going to break down two key concepts that every investor should understand: how stock prices are determined and what market indices like the Sensex and Nifty really mean. By the end of this episode, you'll have a solid understanding of these basics, so let's jump right in. Let's start with the big question: how are stock prices actually determined? You might have seen that stock prices go up and down throughout the day, but what's driving those changes? The price of a stock is primarily determined by the forces of supply and demand. When more people want to buy a stock than sell it, the price goes up. This is because the demand is greater than the supply, and investors are willing to pay a higher price to get their hands on the stock. On the other hand, when more people want to sell than buy, the price falls. But what influences whether people want to buy or sell? That's where factors like a company's financial performance, news, investor sentiment, and even broader economic conditions come into play. Let's break down some of the major factors that affect stock prices. If a company is performing well, meaning it's making profits, expanding, or launching successful products, investors are more likely to buy its stock. On the flip side, if a company posts poor earnings or faces challenges, its stock price may drop. Sometimes entire industries go through growth phases. For example, if the tech industry is booming, many tech stocks will see their prices rise, even if individual companies haven't reported much change. The overall economy plays a big role in stock pricing. Things like inflation, interest rates, and GDP growth can affect how stocks are valued. When the economy is doing well, stock prices often rise because investors expect companies to earn more. Stock prices are also influenced by how investors feel. If people are optimistic about the market, they buy more, pushing prices up. If they're nervous, they sell, pushing prices down. This is why news and events can have such a big impact on prices. Sometimes events like elections, geopolitical tensions, or global health crises can impact stock prices. Now, let's talk about stock market indices, a crucial part of tracking market performance. A stock market index is a measurement of the performance of a specific group of stocks. It gives investors an idea of how the market, or a particular segment of it, is performing. In India, the two most famous indices are the Sensex and Nifty 50. These indices track the performance of top companies in the market, and they're used as benchmarks to understand the overall market trends. Let's start with the Sensex. The Sensex, or the Sensitive Index, is the benchmark index for the Bombay Stock Exchange, BSE. It was introduced in 1986 and tracks the performance of the top 30 companies listed on the BSE across different sectors. The Sensex is often used as a barometer for the Indian economy. When the Sensex is going up, it generally means that the largest companies in India are performing well, which is usually a sign of economic growth. These 30 companies are selected based on factors like market capitalization, liquidity, and industry representation. The idea is that these companies reflect the overall performance of the market, making the Sensex a key indicator of investor sentiment and market health. Now, let's talk about the Nifty 50, the benchmark index for the National Stock Exchange, NSE. Launched in 1996, the Nifty 50 tracks the performance of the top 50 companies listed on the NSE. Much like the Sensex, the Nifty 50 is used to gauge the overall health of the stock market. If the Nifty is rising, it indicates that the largest companies on the NSE are doing well. Investors use the Nifty 50 to measure market trends and make decisions about their investments. The Nifty 50 covers companies from various sectors like IT, banking, pharmaceuticals, and more. This diversification makes the Nifty a reliable index for understanding broad market movements. Now that we know what the Sensex and Nifty are, let's talk about why these indices are important for investors. Indices like the Sensex and Nifty help investors understand how the market is performing as a whole. When these indices are rising, it's a sign that the overall market is doing well. When they fall, it's a warning sign that things might not be going so smoothly. Many investors use indices as a benchmark for their portfolio. For example, if you invest in individual stocks, you can compare your portfolio's performance to the Sensex or Nifty. If your portfolio performs better than the index, you're doing well. If it's underperforming, you might need to reassess your strategy. Indices are also the foundation for many investment products like index funds or exchange-traded funds, ETFs. These funds allow investors to buy a basket of stocks that mirror the index, providing a low-cost way to invest in the overall market. So, how exactly are indices like Sensex and Nifty calculated? Both indices are calculated based on the free float market capitalization method. This means that only the shares available for trading in the market are considered, not the total shares issued by the company. Each stock in the index is given a weight based on its market value, and the index is calculated as the weighted average of the prices of the stocks in the index. This way, larger companies have a bigger impact on the index's movements than smaller ones. And that wraps up today's episode. We've covered how stock prices are determined, the basics of stock market indices like the Sensex and Nifty, and why these indices are so important for understanding market trends. In the next episode, we'll dive into the different types of stocks, from common and preferred stocks to large cap and small cap stocks. So if you're curious about how to choose the right type of stock for your portfolio, make sure to tune in. As always, if you found this episode helpful, please subscribe and share it with anyone you know who wants to learn about investing. And if you have any questions, send them in and we'll answer them in an upcoming episode. Thanks for listening and happy investing.